Hello, and welcome to yet another very special episode of Beyond the Deal. Today, we are back at the golf course. It is 9 a.m. It is already 90 degrees in Phoenix. We might be sweating. It's going to be a good time. Today, we're going to have a pretty fun little episode. I think a lot of people, our whole industry exists because people don't know that you can invest in things that are not the stock market. So today, what we wanted to do is break down the different types of real estate asset classes and maybe even a few bonus ones. We'll get into some of the pros and cons of each one, and we'll just talk about it for you so that you have a better understanding of why each one works the way it does. So let's get into the episode.
Sweet, let's do it, man.
All right, Mike, first shot of the day. Let's smash it.
That'll work. All right, just hit the hole, first one. We're getting out there. Michael's going to do some practice swings. Really excited to talk to you guys about the alternative investment strategies. I mean, just Michael and I 5 years ago really learned about multifamily and what you can do. And there's numerous other categories and segments within real estate that you can get into. So we're really excited to talk to you about it. All right, here we go. Pop fly way out there. Nice work.
So our first asset class today is going to be self-storage real estate. Mike, what can you tell us about the advantages and disadvantages of self-storage real estate?
Yeah, self-storage is a pretty phenomenal category, actually. And it's a lot of people say it's apartments without tenants and toilets. And so if you think of it, right, it's a box, people rent it, people pay a monthly fee, and they store their stuff in there. And so the pros, I would say, is it's relatively recession resistant. It actually does better in the recession. If you think about sometimes there's household consolidation, people move. And so where do they put their stuff? People love their stuff and they're very much attached to it. So they put it in a shelter or in a storage unit and they pay 30, 40, 50 bucks a month. And that's kind of it. So that's a big positive. One of the challenges within the space is sometimes you have to think about saturation and competition. There's a statistic that's like 9 square feet per capita is the kind of target that you want to be in a market where you have kind of just the right amount of demand. So that's one side. The other big positive is it's very little maintenance, right? You can actually run it without employees. So think about this, no tenants, no toilets, no employees,
Right.
Lots of automation. The market though is very fragmented. So there's a lot of mom and pop, that's the small ones left. And then there's a huge amount of consolidation with, your public storage, your big companies, the CubeSmarts of the world that are out there. So it's competitive. It's really hard to get into and it's gotten really popular now. So you're starting to see cap rates in the 4s and 5s, which makes it hard to cash flow, right? Which is kind of what we're looking for.
Absolutely. Yeah, that's the one thing about self-storage is finding those mom and pop owners, finding those deals is not as easy as it used to be when you've got, the CubeSmarts of the world who are really developing self-storage centers in every square block of every city.
Yeah, but if you can find one, a mom and pop, and it's got at least, 200 units plus, put some automation in, put some CapEx in, and you can really, get to the market and really compete with CubeSmart on a much lower scale. So good way to go.
On the green and two, baby. We're going to beat Mike today. It's going to be a good day.
All right, Michael. So talk to me about boutique hotels, short-term rentals. I mean, seems like it's all the rage. It's on Instagram, but there's complexity, right? Like what about seasonality? What about tourism? What about just operations? Like this is not an apartment complex. It's very intense. Tell me a little bit about that.
You're 100% right. And I will admit that I am biased here. I think this is a fantastic asset class because we are buying a boutique hotel right now and it is a tremendous opportunity. But a lot of the stars have to line up for us to find that particular deal. The owner financing, the price per unit, all of these, the market itself. So with boutique hotel, you have to really do your homework. It's not just any market will work. It has to be the right kind of market where the right kind of demand exists. Vacation markets, Scottsdale, Yosemite, all these kinds of places where it draws people for a very specific reason besides just the fact that your hotel is there. The advantages are going to be cash flow. A multifamily deal right now, you'd be lucky to cash flow in the 7, 8, 9 range. A boutique hotel deal can cash flow 30+% annually. And then you have the added bonus of when it's time to exit, it's not a single family home. So the exit valuation is based on the cap rate. So any multiple of that cash flow of your NOI becomes the value of the building. And that gives you the opportunity to do a 3, 4, even 5x if you get the right deal in place with the right amount of cash flow. But you're right. The downside of boutique hotel is that this is a very labor intensive operation, right? It's not just put a tenant in there, kind of forget about it, go buy another building. This is, you are running a business. There's alternative revenue sources, hosting weddings, having, vendors on site, having a restaurant on site, kickbacks. it really requires a tremendous amount of operational overhead and time and management. But I think that this is a very high cash flow situation if you can do it the correct way.
All right. So it sounds like you need some experience for sure. So having people, that know that business, but also a lot of the metrics are the same as we look at multifamily. So the right markets, like you talked about, that tourism piece, a little bit different, but ideally the same metrics, but that key experience is really key.
Absolutely. Short par three, 95 yards, pins right there.
Michael says no T, man. Let's go. All right, Michael. So talk to me about boutique hotels, short-term rentals. I mean, seems like it's all the rage. It's on Instagram, but there's complexity, right? Like, what about seasonality? What about tourism? What about just operations? Like, this is not an apartment complex. It's very intense. Tell me a little bit about that.
You're 100% right. And I will admit that I am biased here. I think this is a fantastic asset class because we are buying a boutique hotel right now, and it is a tremendous opportunity. But a lot of the stars have to line up for us to find that particular deal. The owner financing, the price per unit, all of these, the market itself. So with boutique hotel, you have to really do your homework. It's not just any market will work. It has to be the right kind of market where the right kind of demand exists. Vacation markets, Scottsdale, Yosemite, all these kinds of places where it draws people for a very specific reason besides just the fact that your hotel is there. The advantages are going to be cash flow. A multifamily deal right now, you'd be lucky to cash flow in the 7, 8, 9 range. A boutique hotel deal can cash flow 30+% annually. And then you have the added bonus of when it's time to exit, it's not a single family home. So the exit valuation is based on the cap rate. So any multiple of that cash flow of your NOI becomes the value of the building. And that gives you the opportunity to do a 3, 4, even 5x if you get the right deal in place with the right amount of cash flow. But you're right. The downside of boutique hotel is that this is a very labor intensive operation, right? It's not just put a tenant in there, kind of forget about it, go buy another building. This is, you are running a business. There's alternative revenue sources, hosting weddings, having, vendors on site, having a restaurant on site, kickbacks. It really requires a tremendous amount of operational overhead and time and management. But I think that this is a very high cash flow situation if you can do it the correct way.
All right. So it sounds like you need some experience for sure. So having people, that know that business, but also a lot of the metrics are the same as we look at multifamily. So the right markets, like you talked about, that tourism piece, a little bit different, but ideally the same metrics, but that key experience is really key.
Absolutely.
All right, Michael's about to tee off. Let's go. See how he does here. Looking good. Get up there. A little short, but straight. That's what you want.
All right, Mike, question number 4. Let's talk a little bit about industrial and flex space. This is a very popular asset class right now. So tell us what you know.
Yeah. So when you guys think of industrial, don't think of factories necessarily. Think of leasable buildings, big giant warehouses, the Amazon buildings of the world. So outside of Amazon, there's a lot of users that lease industrial space, right? Warehouse space. They'll take maybe a big building, they'll chop it up and they'll be able to get in there. Now, what are the benefits as a landlord or as an investor? You're seeing long-term leases once again. So that 7, 10-year leases, because these are, again, businesses that are taking advantage of e-commerce. Maybe they're producing something, some kind of manufacturing. They could be just last mile delivery where they bring product in and then just get it out to the marketplace. So long-term lease is great. Minimal maintenance and minimal tenant improvement for the landlord, right? That means you're going to get an empty shell and they're going to build it out for themselves. So, there's something called tenant improvement credit. That's dollars that you as the landlord or the investor would pay. That tenant's kind of build out the space, but it's relatively minimal because these are just big boxes typically. So not a whole lot there for us on the occupancy or maintenance side, right? Some of the downside, you got to just look at the marketplace. Just like anything else or any other category, you might have a lot of warehouses available. I can tell you right now, when we're both in Phoenix, the occupancy in Phoenix on warehouses is in the 90%. So it's actually doing better than multifamily. And they're continuing to build more and more warehouses. And that's because Phoenix has become a big industrial hub. A lot of manufacturing, a lot of last mile delivery. We got all the freeways. So it's a great investment, at least here in Phoenix, but there's other markets where you're in the 50 or 60%, right? So you got to just know your markets.
Absolutely. And do you have any thoughts, these sort of data centers and big single tenant industrial spaces that have become very popular now?
Yeah. I mean, there's more and more of them. They're typically owner owned. So your big Metas or your Googles, they're going to buy the land, they're going to buy the buildings and own those outright. But there's ancillary spaces around there where suppliers to those data centers are going to want to come in, and they're usually smaller, they're less capitalized, so they're more likely to want to rent or lease, which is an opportunity, right? So you're starting to see that, right? Around the Phoenix airport down in Mesa where we are, there's a lot of industrial space that's coming up. And something on that term that's new, industrial condos. So you're taking a warehouse space and you're actually chopping it up into like mini house offices. And you got, smaller operators that are like, they're going to park their RV and their boats, but they're going to run their office out of there too. And so it's a great way to not have office space, but they end up getting office space, but just in an industrial park. So we're starting to see that niche within the industrial market really get popular right now.
That's awesome.
All right, hold number 4. By the way, it's a beautiful day in Phoenix. Oh yeah, goes up there, got a nice, just a hair left, but looking pretty good. Probably gonna be on the fringe.
Okay, it's on the green.
Okay, consistently bogey. So
This is for par.
Michael is about to hit in a par putt. Let's take a look. All right, Michael's on, putting for par. Just kidding. Hey, golf is hard, everybody. All right, Michael, let's talk about another form of housing in the real estate world. Let's talk about senior housing. What are some of the goods and bads and challenges?
Yeah, so senior housing, also called assisted living. You can even actually group sober living homes into this category. They're all really, really fantastic because there's a massive, massive demand for this product. And you get premium rents compared to traditional multifamily with that same long-term predictability. The downside is you have a lot of governmental oversight. You have potentially long lease-up periods. And if you are a poor operator, and you don't have a good facility, then you risk significant reputational damage. So there is a lot of professional competency that is really required in this asset class, maybe compared to just being your standard landlord. However, if you look at the trends of how the birth rate is on decline and how more and more people are, baby boomers are aging out, they're getting out of their businesses, they're going into these assisted living facilities, the demand is extremely strong and the rent capacity is really high.
Yeah, definitely a good category to potentially look into.
Hey, really quick, thank you for watching this episode. I wanted to interrupt for just a second to let you know that if you have ever considered raising capital for real estate deals like I do, my course is now on sale for just $250. That's right, lifetime access for just $250. You get access to all the scripts, all the processes, all the tech, all the marketing. I will teach you everything you need to know in my video course. You can use the link below to check it out. You can hear testimonials from other students. Most of my students are raising an average of 500,000 in their first few months. Some of them have raised 1.5 million. All right, so if you've ever considered doing this, go ahead and click the link below. And if you are interested in one-on-one coaching, that is also something that we can talk about. You can book a call with me. All right, let's get back to the episode. All right, Mike, question number 6. Let's talk a little bit about medical office. This is a very popular asset class in commercial real estate investing. Why would somebody be interested in choosing medical office?
Yeah, so as an investor, again, all the metrics you need to look at. Who is your tenant base? Where's the asset class? And in this particular niche, it's medical office. So we're thinking dentists, doctors, cardiologists, the medical practice field. These practitioners want their own space typically, and they don't typically buy it. They lease it. So those are high operating businesses that you want, right? So credit worthiness, not an issue typically, right? Because again, these are high net worth individuals that have these businesses. So that's a plus. They're usually willing to sign long-term leases because their plan is to stay in business, right? So, and you see a pretty good track record in the medical field in these spaces. So even just general practitioners, cardiologists, so specializing in those pieces, 10, 15-year leases, that's a positive. The build outs, so typically very low tenant improvement credit that we would need to provide as a landlord, because they're going to want to build it out their way. And so their lease might be very low because it's a small space, but they might spend millions of dollars sometimes, right?
Absolutely.
Building out the space. They need specialty equipment. They need all the regulations and requirements that, a medical space would need. It's not quite a hospital, right? But it's a space that needs to meet those medical standards. So for those reasons, it's great. From a con, it's just a matter of the marketplace and how much office space and demand is there. I can tell you back in the recession time, 2008, here in Chandler specifically, so we're in the Phoenix Metro, but down in Chandler, there's probably thousands of medical offices. A whole bunch of them got built. A whole bunch of dentists came, and actually there was a little bit of a retraction in demand because a lot of people left Phoenix, right? So that became a challenge. But if you can kind of see what the market needs are, do your market research, it's a great investment.
Yeah, and I think really the key thing to think here is about, if they have to buy an X-ray machine or a CAT scan or an MRI or something like that, that's a million dollar piece of equipment that is very, very, very expensive and very hard to move. So these people have no intention of changing offices anytime soon. That's the last thing they want to do. The amount of overhead it would take for them to actually pick up and switch locations is tremendous. So if you can get a really good medical tenant, chances are they're going to be a good tenant forever.
And last piece of that, we talked about it on our retail side, is triple net.
Yeah.
So the expense ratio system is triple net. So that tenant is paying taxes, insurance, and maintenance for your building, right? So from roofing down to the bay to the floors, those are typically covered by your tenant. All right, we are on hole 6. Michael's got a $155-ish. He's using a 7 iron. Let's see how we do. Ooh, that sounded really good. It's going up there. Chunk it a little bit, but you know what? It's straight, man. That's what you want. It's good.
Mike is hitting from the right side of the box because he thinks it's gonna go left, and he's right.
Wow. I'm just pulling really left. All right, we got 60 years to go. Oh, there you go. Get up there.
The bump and run. Oh, he's on. He's on.
Oh, a little bit much. All right, man. We are on hole number 7. Having a pretty good day. No birdies quite yet, but we're doing all right. We're having fun.
Yeah.
So let's talk a little bit about land development, Michael. We own a little bit of land, but tell me about, as an investor, that niche is, again, all a little different, but tell me a little bit about land and land development.
Right. And so we've talked about this a couple of times on the podcast before, but the real value here is in buying raw land and getting it entitled and essentially flipping it. So not going all the way through with the development process, but getting it to a point where a developer will be able to buy it and take it over the finish line. And the thing about the entitlement process with land development is it can take a lot of time. I mean, there's some upfront cost. It's going through all the city hearings. It's, getting everything approved. And the second that you actually do get your entitlements, the land becomes instantly more valuable. Now, the downside is obviously there's nothing on the land, so there's no cash flow to be made. And what you don't want to do with a land development is ideally you don't want to get a loan to purchase the land. You don't want to have any debt on this. So if you can, you want to buy it outright. You want to improve it. You want to go through the process of entitling it, and then you want to flip it to the end developer. And I know a lot of people who make a lot of money doing this. It's a very niche type of real estate asset, and it can be very valuable. There's also people who just hold land forever and just, wait 20 years and wait for time to pass. And, that can be very profitable as well. But if you're intending to make a profit on your land sooner, the way to go about it is to get it entitled and then sell it to a developer. The nice thing about this as well is obviously there's no tenants, there's no need to lease it up. There's no overhead at all. It's just raw land, but you have to wait the game and go through the entitlement process.
Definitely a waiting game. And again, potentially some politics and some things you got to work through, but could be very, very profitable. Just might take some patience and time. All right. 168. 5 iron.
Question number 8, Mike. Let's talk a little bit about mixed use. I mean, this is exactly as it sounds. It's aptly named, but tell us a little bit about mixed use real estate.
Yeah, let's define that a little bit. So mixed use is a combination of usually multifamily apartments and some kind of retail down below. So the best examples are if you go to any downtown or even suburbs now, right? You got 2-3 stories of apartments, and then at the bottom you have your nail salons, your restaurants, your coffee shops, etc. So they're a great looking addition to usually any submarket, an exciting place. A lot of new buildings are that way, right? You see some older ones, but any of the new markets, especially here in Phoenix, lots of new mixed use. So as an investor, where do you get in as opportunities for us? Usually you're going to develop something like that. You're not necessarily going to be buying it because they don't actually go on sale very often. It's a great diversified way to make income, right? Because you have, again, the multifamily business, and you have all these individual retail businesses that are mixed in. So you put it all together, professionally managed by third parties. A great opportunity, just very complex. Lots of financing challenges. A lot of these are owned outright, but they get financed in different layers, different tiers. We have not even touched on that. It's an exciting place to potentially be, but we haven't touched on it.
Right. And in certain markets like New York, obviously this has been a thing for a very long time. But in most major American cities, unless you're specifically located in the downtown metro, where people want to be able to not drive and live close and walk to things, that's obviously where it's going to be much, much more common. But like Mike said, it is relatively a newer phenomena in a lot of these major urban metros, besides some of the older East Coast cities. And most of major American cities, specifically on the West Coast, were designed around automobile use. They weren't designed to be walking cities. So this is kind of a newer thing that you're seeing here. And chances are you're not going to have the opportunity to buy one, but you may have the opportunity to develop one if you have the resources and experience, and you get the combo of long-term multifamily tenants, but you also get that triple net benefit of retail commercial.
Yeah, it's exciting. And why do they do that? Why wouldn't they just build it horizontally? Well, it's space. Right. So just like you mentioned, LA, New York, some of these cities that you can only go vertical. And so that's how you do it. You stack retail on top of housing. In markets like Phoenix, we see them a lot more now, but that's because it's a cool thing. And it's really creating that urban neighborhood where, an elimination of cars. Matter of fact, there's a community here called Cul-de-sac where there's no cars. So it's rental apartments and restaurants all around, and you can park your car down the road, but there's no parking actually anywhere on site. So it drives that urban feel.
All right, last drive of the day. 300 yards, teeing up real high. Sounds good.
What did we miss? What else is left in this alternative asset class?
So one thing we haven't spoken about yet, Andrew, is businesses, right? So a lot of people don't know that you can actually invest in businesses and that operators put together funds and opportunities to buy businesses, maybe roll-ups or even pre-IPO companies. There's a lot of things out there that you can invest in that's not the stock market. So we've raised some money before for a pre-IPO medical AI company. There will be an episode about that next week, so stay tuned. We've also raised some money before for private equity roofing roll-ups. Right. So there's a lot of different alternative asset classes that we haven't spoken about that aren't really real estate related. The upside there is your equity can be massive when it comes to buying businesses, because the value of a business is based on something called EBITDA. I'm not even going to pretend that I can remember what that acronym stands for right now, but the central gist of the concept is that if a business does 2 million, then it might be worth a 2 or 3x. But if it does 5 million, then it might be worth a 5x. If it does 10 million, then it might be worth a 10x. So the more money the value of the business creates, actually the increasing of the exponential of the multiple that the end value creates, right? So if you could go together and buy a bunch of businesses in the same niche, like roofing, for example, and sell them all as a package, well, you've just created an exponential equity multiple, and the opportunities for profit there are endless. Obviously, the difference being this isn't being a landlord, this isn't real estate, this is operating a business. So you really, really need a lot of operational competence in order to make sure that those business plans are executed successfully. And if you're going to invest in something like that, you want to have a lot of trust and faith in the sponsor and their track record.
Absolutely. And just obviously getting to know the network is a big piece of it. So listening to podcasts, getting on podcasts. If you run a business, get with Michael. It'd be a great interview actually for some of the stuff that you do that's outside real estate as well. Yeah. So yeah, really good stuff.
All right, we just finished up. We're sweaty. Yeah. It's hot. We played very mediocre golf. So thanks for tuning in to another episode of Two Mediocre Golfers Talking About Real Estate.
That's right. 9 holes, 9 questions. Looking forward to seeing you next time.